And welcome back to another edition of The Road to Financial Independence. I'm your host, Mike Riskin, the president of CPS Investment Advisors. And as always, I'm joined by my partner and CEO of CPS, Peter Golotko.
Hey, Mike, how you doing?
Terrific.
I think we're going to have a pretty good podcast today. Something that really affects everybody.
Absolutely. We did. We kind of did this back when the new tax bill first came out after the summer, and of course, now that tax season's rolling around, we're getting a lot of questions again.
Getting a lot of questions. A lot of really good things are happening.
That's right.
I think most people are going to see a little bit of an increase in their returns.
That's right.
So that's pretty good.
Yeah. And when you say increase, you mean probably increasing refunds, maybe.
Refunds, yes.
Or decreasing their
Decreasing their taxes,
right,
correct.
Right.
Correct.
Yeah. And we'll certainly get into that. I know I've played around with, even though Levi, by the way, we're here today with our tax director of CPS Investment Advisors, Mr. Levi Groover. Levi, welcome back.
Thank you. Thanks for having me.
We had such a resounding response from your first appearance on our show that we had to bring you back. The comments were, please bring Levi back. That was all we heard.
Sure, that's exactly what it was.
Yep.
That's right.
Actually, we were like, who will come back and actually do this?
Right.
And you're the only one. So.
That's right. Most guests won't come back. But thankfully, thank you.
Because there's a 1 hour notice that we need you back.
That's right. That's right.
Yeah. I invited Levi for lunch, and here he is sitting in the podcast studio instead. Appreciate that, Levi. But no, I've played around a little bit with the tax software in spite of you trying to lock me out of the system. But I still got in, played around with it a little bit, and have noticed and just in throwing, and we'll get into the details, but I have seen some of the benefits that our clients are going to see coming up this upcoming tax season. So that'll be good. So of course we're going to be talking about the one big beautiful bill again, because those and the changes. So what the clients are talking about.
Now, are we going to differentiate between what changed for the 2025 tax and 2026? Okay, because not everything applies to last year.
That's right. And that has probably been the biggest challenge, is remembering this is effective for 25, this is effective for 26, and it's still in my mind. Sometimes I have to go look it up again because, and actually probably always, because I don't want to misspeak and say, well, this is how it's going to be. Oh, no, that wasn't for 25. That's only for 26. So
but Congress makes it so easy to understand this stuff that,
100%.
Wow.
I'm glad I'm not a programmer, then don't have to program the tax software either, because that would be awful.
Oh, yeah, that's right. All right, well, let's dive right in. I think the one that is on most of our clients' minds and the one we get the most question about is what people refer to as kind of the break on Social Security tax.
Yeah.
Now, it's not 100% correlated. It's more of a senior credit. Levi, kind of explain that a little bit for our folks.
Oh, so you mean that it's still taxed?
Correct.
Social Security still taxed? I thought they're going to get rid of the tax on that. What's up with that?
Social Security is still taxed, but there is a $6,000, if you will, standard deduction that you're getting at 65 plus. So that's the senior discount that they're giving now for the age limit. And there is some phase out associated with it, but it is a $6,000. They call it a bonus deduction that is stepping in for senior citizens. So
is that per person?
That is per person.
Okay,
yep.
right.
That is
So
per
a
person.
couple is 12,000.
So couple is 12. Yep.
That's pretty big.
So the theory, I suppose, then is someone 65 year old, there's most likely getting Social Security, and so and then they would qualify for this deduction. Hence, so it's not. So even if you aren't getting Social Security, but you're over 65, you're still going to get this deduction, which is best of both worlds, actually.
And there is a phase out, so there is an income level phase out on that, and that is for the higher earners. But yes, and this is a temporary benefit. So this is set to expire into 2028. So it's here for the next, 4 years?
So
25.
So this one does apply for this 2025.
It does apply for
tax
the 25.
season.
Yep. That's right. That's right.
Okay.
So
what are the income challenges?
Man, I don't even know what those income limits are.
Now he's never coming back.
That's right. I don't know exactly what the phase outs are, but there is a phase out limitation, and it's going to table up.
And that's important because our retirees are on a fixed income, and after we saw what happened with inflation over the last 4 years, they're getting hit pretty hard.
Yeah.
Now, in turn, interest rates are going down. So that means anything they're invested in money markets or CDs, they're going to start receiving a lot less income.
Right.
And by allowing them to take a bigger deductions, could put more money in their pocket, and they're going to spend it.
That's right.
Which means the economy is going to do much better. They're going to spend a whole lot better than the government will. So
yeah, this could be pretty stimulus.
Yep.
Speaking that all this money that's probably going to go back into a lot of folks' pockets.
That's right. That's right
for sure.
And it always is, right?
Yeah.
I mean,
no, when people get extra, we always say for every $100 Americans make, we spend 120. So that will continue.
That will continue to be the case. People have more money in their pocket, they will spend more.
More money, more spending. That's right. Well, awesome. Well, that was certainly a big one. Let's talk about some of the items that may have been on the chopping block that aren't maybe new, but this was some of the provisions that were set to expire that really would have had a negative effect on most taxpayers in terms of them paying more tax. One of them is really just talk about the rates, and without getting too in the details, just the sense of there's buckets. So like your first X amount of dollars is taxed at 0%, then 12, 20, and so forth.
And I love that you said 12 as the first rate.
That's right.
Because that's not our first rate, right? So in 2017, the first rate was changed to 10.
Okay, 10. There you go.
10%, and that was set to expire at the end of 2025 and go back to the 12.
Okay. Yep, there you go.
So that is one of the things that was going to be a detriment to everybody, because it was going to jump back up. All the rates were going to go back to the original rates. And I think the highest then was 39%.
It was 39.6.
Yep, 39.6. So that was all set to come back effective for 2026.
Right.
The tax year of 26, not when we prepared the 25 tax. But so we are staying at the 10, the 12, the 22, the 24, 32, 35, and 37 rates. So we are not increasing our tax rates. We are staying at the lower rates, which is a big plus. So we're not going to necessarily see a change in our pockets because they made it permanent.
But we could have seen a change if they didn't.
That's exactly
people would be bringing home a whole lot less money.
That's exactly right.
And that's one of those where, and again, we've talked about this before, where I know a lot of the focus seemed to be that, this is a tax break for the wealthy. But when you look at an item like this, this certainly would have affected everybody. And percentage-wise, disproportionate to the folks that probably made under $200,000.
That's correct.
So and even that senior discount or deduction is another one that's going to help folks that make certainly less.
That's right. That doesn't
35% bracket.
Most of these tax cuts do not help the rich.
Right.
At all.
That's right.
And there are some people out there who high income are paying 37%, where there's not a lot of deductions for them, and there's not a lot of tax cuts, and that's where they need to be. However, all these are going to bring people's tax rates down, keep them down, and put more money in their pocket. And that's good for our economy. That's good for jobs.
Right.
Yeah. So I think this is a right way to go tax-wise. And we'll probably collect more taxes by doing this rather than raising the rates.
That's right. Yeah.
I might have misspoke a bit ago when we were talking about the senior deduction. I think I called it a senior deduction, and really that's more of a senior exemption.
Okay.
Right? Because the other big plus that it was made permanent through the One Big Beautiful Bill Act is the standard deduction.
Okay.
Was again set to go back to the original rates, which were, for married filing joint was like $12,000, $6,000 for single, or whatever those numbers were. Now we're going to be closer to the $30,000 mark for married filing joint, and closer to the $15,000 mark for singles.
That's quite a big difference.
Huge difference. And again, that was made permanent, and those are going to be indexed for inflation. That'll continue to happen, but we were going to revert back to the Tax Cut Jobs Acts to the pre-2017 rates.
Yeah, if you're married, you get $31,500.
Thank you. So we are over the $30,000 that I was thinking.
If you're single, it's $15,000.
Right.
Yes.
So
that's huge.
That's really
that's
big.
quite a difference. Yeah, no, it's good. It's good that they kept those in place. Again, really helping out the taxpayers at all levels.
That's right. Yep, that's exactly right.
Nice. Another big item of discussion was, and this is one that affected our financial planning advisors and what we do at CPS a lot is the estate and gift tax exemption for, I don't know, it seemed like 4 or 5 years now. We knew that this law was about to expire, which basically would have put the exemption from like 12 million of taxpayers back down to 5.
Yep. Ouch.
And so we had so many clients asking us, what should we do? What should we do? What should we do? And the advice really was just, hang on, let's not do anything until we really get closer and see what happens, because you'd hate to make a move where then the change didn't end up happening. And thankfully that advice was good, because what ended up happening was they did extend the exemption and then some. So kind of talk about what they ended up doing there, and is this just a temporary fix? Is it permanent? What does that look like?
So the exemption is permanent. So the increase is permanent, and it will again be indexed for inflation every year. And instead of it being at the 13.6, it's going to 15 million for 2026. It was going to revert back at the end of 25 to the $5 million mark.
Right. That's quite a big swing.
Monster swing. So from that perspective, it gives us room to work and to plan, and really provides a level of comfort to everybody. And the index for inflation is another big piece that I'm glad they're making that part of the permanent adjustment that will happen every year.
Okay.
Because it was happening, but it was tied to a rate. I can't remember what year the rate was. Whatever that year the inflation was is what the adjustment was tied to. Now it's going to be tied to the current year. So as it adjusts, it'll be based off of prior years' inflation rates.
Okay, nice. Now when someone passes away, family member passes away, regardless of the size of your estate or what you think you own, would you recommend? So what are some recommendations in terms of going to see your CPA or financial advisor and kind of doing a financial statement, a personal financial statement? Because a lot of times between like step up in basis on stocks, a home, a second home, just because you think you're under that threshold of 13 million, there's a lot of other issues that come into play when someone passes away that you need to think of that a CPA would evaluate. I don't know, Pete, you want to chime in too? What you should do when that happens, and to get the value of your estate, but also those little other things that are important that a CPA can help you with.
So at passing, anything that's not liquid, stocks and bonds and stuff like that, real estate, you're going to have an appraisal.
Okay, there you go.
And when they do an appraisal, does that appraisal, now that in 26, I believe it's 15 million, does that appraisal bring your estate above 15 million? That's a question if you're single.
That's what you need to find out.
Yep.
Yeah.
Now it's 30 million if you're married.
Right. But
again, do you have assets that might add to your estate? Life insurance also adds to it, unless it's an irrevocable life insurance trust.
Right.
So you need to look at your balance sheet. And if you're getting close to these numbers, we need to have a really serious conversation, because anything over the exemptions, that's taxed at 40%. And if you got a lot of illiquid assets and you don't have enough cash to pay the tax, that's got to be discussed also, because we don't want to be fire selling property just to pay IRS tax. Owners of closely held businesses, those are issues too. What's your business going to appraise at? And if that's where a lot of your wealth is, can we get enough out to actually pay the tax, or what do we need to do? So, even though we got that huge jump in exemption, we still need to keep an eye on what's going on as your wealth grows.
Well, and with that, the other piece that we have to consider, and we're very fortunate being in the state of Florida where there is no state income tax, but we also have to look at the impacts of the states where potentially some other assets and or residences are concerned. So there's that, because there's also the state laws that apply to step up in basis. Some states. So there's numerous issues that we have to consider there from a planning perspective. But that's the joy of what we have with you guys, is an opportunity to bounce thoughts, do the research, put the effort into it on behalf of the client, what the best case scenario is.
Right. And having real estate, and since we're talking a little about estate planning, having real estate out of the state you live in adds a pretty serious wrinkle.
It does.
Because to send that through probate, you're going to have to hire an attorney in that state.
Right.
So a lot of people are like, well, I got a mountain home in North Carolina, I got a place at the beach, I got a place in California. Well, understand that when everybody has to pick up everything that's left over, there's going to be a lot of work that needs to be done just to fix all that.
Yeah. And then, of course, it's the estate and gift tax exemption. And I think the gifting part sometimes gets overlooked. But that's one of the cool things that we work with our clients a lot is on, even if they may not be pushing up against that $30 million. Obviously, if they are over the $30 million or $15 million per person, the gifting strategies come into play big time.
Absolutely.
Whether you take advantage of that annual limit of $19,000 per person per family member. So there's a lot of opportunity there to gift. But one of the cool things working with our clients that we notice is sometimes they think, okay, I'm going to let, I'll die, my family will inherit the money and whatever. But if you've done the right planning and you have enough to live off of, gifting while you're alive and seeing the benefit or your family members benefit from that gifting is really a cool thing and really adds value to the people doing the gifting. I just worked on a client who was gifting some money to grandkids, but they didn't just want to give them the money. So we did a thing where I said, hey, why don't you gift them the money? They get to keep a portion, but the other portion they had to donate to a charity. And because these kids were in their teens and early 20s. So, love that idea. It got some money out of his estate. Over Christmas time, he got to talk to the grandkids about this. The grandkids were researching which charity they wanted to give to. So it's added such value added to the family.
And they also can do like a Roth contribution. If you got a child that's got a part-time job, they make $1,000. You can stick $1,000 in the Roth form, and that's money out of your estate, but it's also money going to an account that's going to grow dramatically for them over their lives. So
that's another great
one. And do that every year that you can. And even when your kids are older and they're doing 401ks, but they're not able to save a lot of money, you can still do a Roth form or an IRA form there using your gifting.
That's right. It's perfectly allowed. No, awesome. Talk a little about the charitable giving, Levi. I know there was a couple tweaks there. You are still allowed to do take an itemized deduction on charitable giving. But there's a couple different things you can do going forward.
Yes. So one of the, if we remember back during COVID, they did a $600 allowance, if you will. If you donated to a nonprofit organization, you'd get a $600 front of the page deduction above the line that just helped reduce your taxable income. They're doing the same thing again. Now it's increased to where it's $1,000 for single filers or $2,000 for married filing joint.
Okay, so they upped it a bit.
They've upped it a little bit. So if you don't itemize, but you've still been charitable, you've still given to charitable organizations, they're going to allow you to take a deduction up to $1,000 or up to $2,000.
That's great. Yeah, because we've seen that with as we mentioned, the standard deduction now is $31,000 for married couple, which really is real estate taxes, mortgage interest, and charity.
Yep.
For most folks, that's a hard nugget to get over there.
They're going to have to give a lot of money to charity.
Right. And if you don't, you still at least get the $2,000. It sounds like.
You still at least get a front page, and that goes a long ways. Again, talk about putting money back in your pocket. You weren't getting it before. Now you're getting it.
No,
so that's going to be a big help.
Yeah.
One of the downsides is they did put a floor now for higher earners. There is a floor. It's a 0.5%, and I haven't seen it in any of our projections.
So it's a 0.5% of what?
0.5% of your of your AGI.
You're limited to putting in 0.5%.
Well, no. There's you have the AGI, and then you calculate 0.5% times your AGI, and that's so like the first 0.5% of your AGI is not deductible, and then anything above that is deductible, kind of like they do with the medical.
Yes, that's the exact same thing. Yep, it's the exact same thing.
That just seems counterproductive to me for charity because
100%.
That's going to keep people from donating.
Right, and it's going to affect your higher income earners.
Yep. Yes.
It's going to get.
That's another tax on high income earners because they're not going to get the benefit of that first 0.5% of income.
Yep. So when we say that,
and that floor is going to be a lot higher,
benefiting the rich, it's like, well, actually, there's a lot of things in there that limit what they get. So
nice. The next couple, I know we've had great conversations so far. Just the ones that got a lot of the headlines, the no tax on tips and no tax on overtime, those are still going into effect. Is that correct?
That's right. Yep. Those are going into effect. Those are going to be, I don't know that we'll see a whole lot of, I mean, we're going to see it, don't get me wrong, but it's not going to be an impact for everybody.
Right. It's a very specific.
It is. Yeah.
And even the overtime, I think there's certain rules around that.
There are.
I know we discussed moving all of your salary to overtime, and we were told we can't do that.
We tried to get creative.
That was good planning.
It was good planning. I don't know.
Tried to get creative, and there's rules on tips. There's certain industries that they've qualified it for
That's
as
right.
well. So it's similar to our QBI deduction, in that there's certain industries that qualify for it, others that don't. So that's some of the things they put out there, some of the rules. And as we get those in, we will look at that to make sure that we're there. But
as always, read the fine print on really understand
if it applies to you.
Don't just assume you worked overtime and it's not going to be taxable.
That's right. Yeah.
There's a lot of hoops you got to jump through to get that.
Yeah, there's some rules attached to this thing.
Yep.
All right. Another cool one is this 529 plan. Before it was really limited to higher education.
Yes.
And now they've really expanded it to include. Well, I'll let you explain what they've expanded.
There's a big enhancement there, where now it's allowed for your local private schools, education or lower education, your K through 12. They've expanded it to allow the 529s to help with education expenses for those. They also expanded it at the post-secondary level, where it's going to be allowed for other expenses associated with school that weren't allowed to, where it was basically just education. Yes, just tuition. Thank you.
And I see also even some homeschool expenses.
Yep.
On there.
And if you get the CPA exam.
That's right. That's right.
Yeah, they say right here, in particular, CPA credentialing would also be allowed to, including the exam expense.
That's the AICPA right there. Touting,
that's
hey,
right.
let's get more people
We
going.
need more CPAs. So if you're planning on going to college and you listen to this, go get your CPA certificate.
That's right.
That's right.
Yeah,
That's
The
right.
529 plan works.
That's right.
And one day you too can be on a podcast.
That's right.
on a 1 hour notice.
On a 1 hour notice. That's right. Couple of business provisions. Oh wait,
well, I got one here.
Oh, yeah.
that kind of surprised me. It's the deduction for interest on car loans.
Oh yes.
Yes. So up to $10,000 limitation. Again, there's income phase outs, but up to $10,000, it has to be assembled in the U.S. It has to be a new car in order to qualify for that interest deduction.
Okay.
But yes, that is a new piece they did. Again, trying to help stimulate the economy.
That's right. So if you did buy a new car, then certainly turn that into your CPA
100%.
and make sure
as long as it's manufactured in the U.S.
in the USA.
There's qualifiers there. There's on the interest statement. There's supposed to be some different pieces that will help us know to look up the car, because there's sites for us.
And I like that, because if you look at the payments on new cars now, even new used cars, they're paying $1,000-$1,200 a month.
Oh yeah, I know it's
that's
car loans have gotten
to get some kind of deduction for that is great.
Like buying a home.
That's right.
One of the other big ones that actually I was happy to see is the increase in the SALT tax.
Oh yeah. And that's the state and local tax.
Local income tax. And I thought that was a pretty low blow when they brought that out, because it only affected a certain amount of people out there who are in high tax states.
Yeah. Right.
And it was a pretty bad thing for them. I mean, the deduction went away.
Yeah.
People paid a lot of tax.
Yep.
And there wasn't a lot of people happy
And they
about
capped it at $10,000.
Yeah.
Which included your property taxes.
That's right.
That's right. And
So-
sales tax.
And sales tax. Yeah.
Yep.
So
this now has increased to $40,000.
and it's still not the best. I mean,
It's not.
still not going to catch everything, but at least it's a little bit better for people.
That's right.
And that I see that phases out at 500,000.
That's right.
Income,
There's again phase out
your
limits.
super higher earners will still be stuck at
Will
10.
still be, they won't be able to get any of the benefit.
And those are the things that we look at when we're again, not a lot of Florida impact on that piece, right? But when we're looking at QBI deductions, we always want to consider the SALT, the state and local tax, because if we're paying more in the taxes at the state level, we might want to adjust what our QBI deduction happens on the business side, because there's pieces that happen, ebb and flow is the proper term there. So
That's right.
we do try to take all things into consideration.
No,
there.
sure. Yeah.
So
yeah, and especially in Florida, if Governor DeSantis gets his way this session, no Floridians will have to worry about their property tax on their personal residence.
That would be nice, but I want to see how
a lot of controversy surrounding that one.
Yeah. Hey, as long as we tax all the visitors that come to
that's
the
right.
hotels, right?
Raise the hotel tax.
Yeah. Then I won't be able to
for
go watch wrestling
Oh
tournaments.
boy, that's right.
That's right. That's right. You'll be paying more.
Yeah.
Right. So I didn't mean to step on the red ant hill there and start the firestorm, but just thought about that as we were talking about property tax deductions.
I've had some clients ask me about the new Trump accounts that are coming out for kids that are born they're born in 2025 and on.
Right.
So there's still a lot of unknowns there, and what I mean by that is what's going to happen when the kid ages beyond that 18 limit, right? There's a lot of unknowns there. I mean, there's a lot of
being used and stuff.
Yes. How's it going to be treated? What's it going to be rolled into? But there's a lot of also good benefits. I don't know the exact years, but if a kid is born, I want to say 25 through 28, that the government's going to kick in an additional $1,000 into the Trump account. I mean, there's some great benefits that come from that. Another piece of that 529 ideology of how do we help our kids, our grandkids, right? This is another opportunity.
It does seem kind of like free money.
Yeah.
That at least at a minimum, because I know there's restrictions on what you can invest it in and stuff, but you open it up, it's free money. You might as well look into it.
Right. And also for grandparents or parents that want to
100%.
put some money away, this isn't a bad route.
Yep.
And so, and just looking at some of the details here, that the government was going to give you $1,000 right out of the gate, so that's the free money. And then there are opportunities to contribute it up to $2,500 to $5,000, depending on the situation.
If a grandparent wants to put money into the Trump account, it still counts towards that limit. It's
Correct. Right. And I think that the limit is up to $5,000 a year.
Okay.
In the aggregate. Yeah. So, all right. Trump account. So let's talk about for businesses. One of the for our business owners out there. Let's talk about the 199 deduction. I hate to use code sections, but really, what does that mean? Is that it was for S corp owners?
The qualified business income deduction. I love it. I was a big proponent of it when it first came out. I was scared. It is a big benefit to business owners right out of the gate. Again, there's phase outs, there's industry limitations, those things, which we watch, which we try to be mindful of. But they have made that permanent, so that is not going to be going away from us. And then they've also added another little piece here. As long as somebody is eligible for $1,000 of QBI deduction and they phase out, they're still going to get a $400 QBI deduction.
Good. They're going to get a little bit of something.
Yeah.
So that helps the small business, small businesses out there.
Yeah. So there's a benefit that comes from that. This was probably one of the things I was the most excited to see
continue.
Yes. I was hoping for a little more expansion, removing some of the industries away from the limitations on it.
Well, that's where they get the rich.
That's right.
Because the industries that they limited from this deduction are the industries that make the most money.
That's right. Yep.
So those industries don't get this QBI.
Yeah. Your service industries, unfortunately, medical industry is one of those service industries that doesn't get the QBI deduction. Attorneys don't get that QBI deduction.
Another area where they didn't give a break to the rich.
Right.
And if you look through this, there's not a lot of breaks to the rich because everything's phased out. Once you get above a certain level, you don't get anything.
That's exactly right.
No,
somehow real estate agents must have had a really good lobbyist.
Of course.
Because real estate does not get hit by that service industry.
Really?
Yeah, kind of.
Good job,
weird.
Yeah, well,
somebody just paid the right person
when the
lobby that.
market's going up, they're making a lot of money. But if the market's not going up, that's tough.
It is.
So
Yep. I mean, there's a lot of benefits there, but I love that QBI deduction stayed.
Right.
We do see it a lot. It is something that we watch and are trying to make sure that we get that advantage for our clients.
Yep. And then the final one here, sort of with the R&D, the research and development, affects a fewer folks out there. But for those people that do own companies, particularly manufacturing companies or companies that do kind of have research and development type costs, explain that a little bit, because what happened last couple of years was really bad in terms of what they're able to deduct, and they've changed the law now back to what it used to be to get that maximum deduction credit, I should say.
Yeah, so what was happening is if anybody in an industry where they had to research and develop something, so say you are a custom cabinet manufacturing company, you are designing the cabinets, you're going through this process, all of those costs in the design piece had to be capitalized and then were expensed over a 5-year window.
Right. So even though it cost you $50,000 this year to do it, you couldn't take a $50,000 reduction.
Right.
You can only bleed it out 10 a year.
Yep.
That's right.
Yeah, that's pretty bad.
So that happened, I think it was in 2023 is when we had to start capitalizing those costs. The rule expired. They went back and forth for 2 years, 3 years, trying to get it back enacted. Finally, it's come back in where now we can expense the $50,000 from your example. We can take that expense and put it all in 1 year, because that's the reality of what it is, right?
Right.
So it should be allowed in the year of when it was developed. So that was a big piece that came in. A couple other things. Bonus depreciation is back now to 100%.
Okay, nice.
That's not phasing out. I think it was supposed to be 40% for 2025. We were only going to be able to take 40% of a deduction of an asset.
So our clients are still going to be calling us at the end of the year telling us they bought the new truck?
That's right.
Yeah.
That's right. Yep. And instead of only being able to take 40% of it, we can take 100% of it.
Got it.
And then Section 179 deduction was also enhanced.
Okay.
Again, another bonus depreciation piece that was brought back and enhanced and increased the limitation. So from $2.5 million, now it's at a $4 million threshold.
Nice. So really, our companies out there that are making large capital investments, machinery, equipment, instead of having to depreciate those over 5+ years, really being able to take that deduction in the first year is a massive benefit to those small businesses that are producing stuff.
That's right.
I may have missed it on the research and experiment and research and development, but this really is for small businesses.
Oh, yeah.
And they actually can go back to 2022 and retroactively get a refund.
You can amend your tax returns.
You can amend your tax returns.
Yep.
Yep.
So for a small business, that's a pretty nice option for them.
Yeah. I think they're allowing us to take and actually catch that up in 2025.
Okay, so we may not have to amend
That's right.
anything.
So that's something that we'll evaluate, where that comes into play. And again, we're very fortunate to not have to deal with a lot of the ins and outs on that piece, but we do have some clients on our side that have been impacted by that. So that's something that we'll watch for that.
Yep.
So
Okay.
Yep.
Nice.
Yep. There's some cool things with that. Being an Idaho guy, farmers were eligible for this research and development expense, so we saw it a lot in Idaho.
Mm-hmm.
And so when that came back in 23 and stopped that limit, sorry, it was 22. When that came in and wasn't allowed in 22, I mean, it hit. And when I say it hit home, it hit home.
It increased taxes on people that probably shouldn't have had taxes increased.
Well, the farmers that complain they never have money, right?
Yeah, well, yeah.
That are driving $250,000 tractors every year.
Well, we're not going to go there, Clark.
I'm harassing. I'm glad that we have them. I'm glad that they do what they do because, it helps all of us.
I don't grow my own food.
So
that's right. That's exactly right.
I heard that they give a tax deduction for electric trucks. Is that what kind of tax deduction?
Where are we going here, Pete? Where are we going here?
Are there any tax deductions for electric vehicles?
That
still?
went away in September of 25.
Okay.
So that credit is no longer available for even used. There is no longer a credit there effective September of 25.
So those that are going on say, I'm going to get an electric car because I get a tax deduction for it, that went
That's
away.
no longer.
That went away.
Okay.
Yep, that went away.
Yeah.
Yep.
Although I did learn a new term the other day, a frunk.
A frunk.
Yeah.
Did you know that word?
I'll
A
show,
front
Do you know
trunk?
That's what a front
I'll show
trunk.
you.
A frunk.
If I see somebody lift up their trunk hood and there's nothing in there, I'm probably gonna freak.
You'll see it. Yeah.
The trunk hood.
Somebody the other day had their hood open and it looked like they had car trouble. Nope, they were just pulling out their golf clubs or whatever.
Oh my gosh, that's too funny. That is too funny.
So there you go. You never know what you're going to learn on the road to financial independence.
That's right. We learned frunk.
Frunk. The word of the day is frunk. That was my word of the week.
Now, remember growing up, those old VW bugs?
Yeah.
They had frunk.
That's right. They had a frunk.
They did.
And the where the trunk usually is, that thing didn't work very well either. So I mean,
I think there's some high-end luxury sports cars too that.
I'm sure there are. Yeah.
Nice. And the electric trucks. Well, anyway, I think that's enough for today. Levi, thank you as always. Pete, appreciate you. And it's good stuff.
And if I misspoke, call in, tell me I'm wrong.
Oh, we will. We'll
learn together.
Right.
We're going to research everything you said, and then we'll bring you back on. And
that's right. And for Levi's family, he'll be in the office until April 15th. If you are looking for him, you'll know where he'll be.
Send out an SOS.
That's right.
Yeah, tax season's starting, isn't it?
Here it is. It's upon us. And I again, the nerd side of I look forward to it because with all these tax law changes, we get to see how we get to enhance everybody else. So fortunately for us, it is going to be that type of year where we get to call and say, hey, this law helped you this year.
Right. And if you use a CPA or somebody to do your taxes, give them a little bit of grace.
That's right.
Because between January 1st and April 15th, they work a lot of hours and a lot of stress. So give them a little grace. Yeah. They're not perfect, but they do really good work and they work really hard.
That's right.
We try.
All right. Well, thanks, guys.
Thank you.
And if you like this content, please don't forget to subscribe to us on our YouTube channel. And as always, you can reach us at www.cpsinvest.com or feel free to give us a call at the number on your screen. We'd absolutely love to hear from you.
The information provided in this podcast is for informational and educational purposes only and should not be construed as investment, legal, or tax advice. CPS Investment Advisors is a registered investment advisor with the U.S. Securities and Exchange Commission. Registration does not imply any level of skill or training. The opinions expressed on this podcast are those of the host and guests and do not necessarily reflect the views of CPS Investment Advisors. The information discussed is believed to be accurate at the time of recording, but may not remain current. Listeners should not consider the discussion or any information shared as a solicitation or recommendation to buy or sell any particular security or investment strategy. All investments involve risk, including the possible loss of principal. Past performance is not indicative of future results. Before making any investment decisions, listeners should consult with a qualified professional about their individual circumstances. For additional information about CPS Investment Advisors, including our services and fees, please review our Form ADV, which is available at www.advisorinfo.sec.gov.